now we are going to bring in Joe Bauernfreund and hear a bit about what AVI Global Trust has been up to. So, Joe, over to you.
Thank you very much, James. Good morning, everybody. I hope James and all of you listeners can hear me. So what I'll do over the next few minutes is talk about AVI Global Trust, highlight some of the features of the global market, and then discuss how AVI Global is positioned within that broader market context. And as usual at the end, very happy to take any questions. So just as a reminder, AVI Global Trust is now about £1.3 billion of assets. It's a very concentrated portfolio, very benchmark agnostic, roughly 25 core names in the portfolio with a top 10 concentration of just under 60% currently. Our own discount has been narrowing over the last few months and stands at approximately 7% today. And in terms of performance, over the last 9 years or so since I've been managing the trust, we've performed more or less in line with the MSCI World Index. But clearly, over the last 12 months, we've fallen some way behind that broader benchmark, and of course we'll discuss some of that as we move into the next slide, please. So your listeners will be well aware that the big story of 2024 was the continued very strong performance of the S&P 500, and within that, more relevant is the continued very strong performance of the so-called Magnificent Seven, which leaves the S&P 500 trading at extreme valuation metrics based on a variety of different metrics. Here's just one on the chart here, but also leaving the performance in a very concentrated small group of companies. And what that has meant, when you look at the next slide, please, what that has meant in turn is when we look at our investment universe and our opportunity set, the areas where we typically find the most interesting opportunities have really been left behind when it comes to looking at valuations. So you'll all be aware of what's gone on in the closed-end fund space over the last few years with discounts widening. On the graph on the right-hand side, we show discounts currently on average on the alternative space, very much at the wider end of the historic range, some marginal narrowing, but obviously very, very wide. A similar pattern within the holding company space, which is a key feature of where AVI tends to find interesting opportunities, and that is globally, both in Europe, Asia, and also in North America. Discounts very much at the wider end of the spectrum. And Japan, of course, remains a land of very interesting opportunity as far as we're concerned. Discounts have narrowed a little bit over the last few years, and we'll come along and talk about that. But in essence, Japan remains a very exciting opportunity. And in aggregate, what that means is that when you look on the left-hand side and you look at weighted average discount on our own portfolio over time, you'll see that the discount currently, the weighted average discount on AVI Global's portfolio is very close to 40%. It's around 38%. In and of itself, that's particularly wide. But what's extremely interesting about that is that these levels are the kind of discount levels historically we've seen at times of market stress, dislocation, and panic. They're not the kind of discounts you see when things look relatively benign, if not positive. And that's what's really interesting to us, and in fact quite exciting. The fact that so much attention has been focused on an ever-narrowing group of companies, leaving much of the market on quite attractive valuations at a time when that narrow group is looking very expensive. It is quite interesting and compelling from a valuation perspective. On the next slide, well, just to highlight the long-term performance here, and you'll see performance more or less in line with the World Index, but obviously that's slid back over the last year. But moving on to the next slide. And in terms of our process and how we invest and what we're looking to do, it is very much a bottom-up approach. It's very much a high conviction approach. And it's not just about investing in companies that are trading at very wide discounts or very attractive valuations and then hoping for the best. It's a very proactive investment process that involves a degree of shareholder activism or engagement with the boards and management of the companies we invest in. It's quite an idiosyncratic approach in that we are seeking to deliver or benefit from catalysts or events that will in and of themselves narrow the discount rather than just rely on a hope strategy that things will get better and discounts will improve. Over the course of the last 12 months, we had a number of substantial and successful exits out of the portfolio. Two alternative asset managers, KKR and Apollo. KKR has been in the portfolio since the COVID sell-off, Apollo a bit later. Fantastically successful investments Hypnosis clearly benefited from our activist involvement in the situation there, which delivered very strong returns for us and other shareholders. Schibsted, an example of a holding company where we identified an idiosyncratic catalyst for narrowing the discount and benefited from that. As capital was received from those successful exits, it was redeployed into new and existing names in the portfolio, building up, again, high conviction, high confidence situations. 3 examples here, 2 holding companies, each are in Belgium, News Corp and North American, and Crystalis, the closed-end fund. But again, chunky positions. And each of these, as I'll come along and talk about, are not only trading at very wide discounts and attractive valuations, but also have quite explicit and meaningful catalysts that we think will unlock value in time. On the next slide, just to put a little bit more detail on that, almost half of the portfolio is invested in family-controlled holding companies or conglomerates, where we see a material discount to a net asset value or sum of the parts valuation. A key feature of what we do is it's not just about buying a pound of assets for 50 or 60 pence. Oftentimes, those kind of opportunities exist where the pound of value is in decline and unlikely to grow. We differentiate ourselves from many other value-minded investors by focusing on the asset quality. And that goes for not only the holding company space, but also the rest of the portfolio. We need to see situations where not only are we trading on very wide discounts, but also we can see potential for growth in the value of those businesses. And that's derived from the quality of the businesses we own. Clearly, we're finding undervaluation, both in terms of valuation metrics, PE multiples, other earning multiples, but also in terms of the discount. 3 or 4 years ago, there were a good number of holding companies around the world trading at premium to NAV. They don't exist anymore. And as I showed you earlier, for the most part, European and North American and Asian holding companies are trading at the wider end of the historic range. But the situations that interest us and the ones that find their way into the portfolio are those where there's a more explicit event. And even though we can't be a forceful activist in a family-controlled company, nonetheless, we're invested in situations where management themselves are pursuing policies and paths to unlocking value for controlling shareholders, but also minority shareholders. Within closed-end funds, it's been a fantastically interesting space and attractive opportunity set for us over the last couple of years. As many potential investors have exited the sector, and as poor performance has also contributed to that exit as well as other factors, we found ourselves being able to buy into situations on historically wide discounts. In a number of cases, we are the largest or dominant shareholder, which places us in an important position when it comes to engaging. And generally, the whole idea of more corporate activity, more shareholder activism in the sector is, generally speaking, a positive in the sense that investors will benefit from narrowing discounts and greater interest in the space. And finally, Japan is roughly 20%, but probably increasing in time, allocation within AVI Global. 6 years ago, we launched a dedicated Japan strategy to exploit the very, very material undervaluations that existed in Japan, particularly from companies that had substantially overcapitalized balance sheets, huge amounts of cash that were sitting idly on those balance sheets. And in the past 5 or 6 years, there's been a tremendous movement to reform attitudes to corporate governance and to improve attitudes to shareholder returns. Back then, we argued Japan this time was different. I think that argument has now moved on. Proved the point, Japan has changed for the better, and we're now at a point where there's very, very high levels of corporate activity, high levels of interest from management of companies to engage with shareholders such as ourselves, to listen to ideas and to drive share price performance, with the icing on the cake being a very active market for corporate activity and changing corporate control that's leading to substantial premia being paid when companies are taken private by management or by private equity or by other companies. So in all 3 areas where the portfolio is largely exposed to, we're seeing record-wide discounts as well as very explicit indications of idiosyncratic events or catalysts to narrow those discounts. So if we move on, we'll come back to this at the end, but this is the entire portfolio, and I'm happy to take questions on any of those. But before we do that, let me just give you 3 examples amongst our largest investments currently to illustrate the points I've made. So on the next slide, we start with News Corp, well known to many investors as being the family-controlled holding company of Rupert Murdoch. In meetings, this often raises eyebrows, and Rupert Murdoch's reputation for looking after himself and his family as opposed to shareholders is an issue. But let's just start from basics here. What we look for at AVI is good quality businesses trading at substantial discounts with the potential for something to happen. In the case of News Corp, there are essentially two businesses that are the key to understanding the situation. The first is REA Group, which is a listed Australian company. News Corp are the majority shareholders in REA Group. They've owned it for a number of years. It's been a tremendously successful investment for them. And REA Group might be a familiar name to listeners. This is the Rightmove equivalent of Australia. And indeed, REA Group attempted to launch a takeover bid for Rightmove some months ago, which didn't go anywhere. So it's a market leader, well ahead of its competitors, and it's a very high margin, profitable business. When we look at the share price currently, it's roughly $28 a share of News Corp. Of that $28, the value of the stake in REA Group represents around $21. So a meaningful, substantial proportion of the current share price is covered by the stake in REA Group, which leaves the rest of the assets, which are unlisted, valued for around $7, which breaks back to an earnings multiple of around 3.5 times. Now, what do you get for your 3.5 times? The jewel in the crown here is the 100% stake that News Corp owns in Dow Jones. Now, Dow Jones itself has two key businesses within it. The first is Wall Street Journal, and the second is a business called Opus. Wall Street Journal, very successful media company, now largely online, very, very profitable, successfully transformed from print to online presence with a strong, large subscription base. Opus is a business that is similar to Bloomberg, focused on the commodity space, primarily the oil trading sector. Again, it's a very, very high margin, attractive business. And that's what you're getting for 3.5 times earnings. Now, what could it be worth? Well, the closest peer is the New York Times, which has a listing on the US stock exchange. It doesn't have the Opus business, but it has the media business, and that trades at a high teen multiple. So it gives you some indication of the materiality of the discount that exists on the group. Now, what might happen? Clearly, Rupert Murdoch and his family are not going to listen to us. We may have dialogues with management, but they'll do what's good for them. What's interesting on this point is that when we listen and speak to the CEO of the company, who's not a member of the family, he's become extremely explicit about the board's and shareholders' frustration at the discount, confirming the magnitude of the discount that we argue exists today, and talking about a revolutionary strategic review as opposed to an evolutionary strategic review. Now, there are a number of things they could pursue here, but ultimately the problem in terms of valuation exists because the complexity, the lack of transparency, the lack of understanding as to what the private assets are worth confuses investors. And when you start analysing the financials of companies like this, where you've got listed stakes and 100% ownership stakes and minority stakes, the accounts look quite confusing. So somehow spinning out REA Group, being News Corp more as a direct holding company of Dow Jones would bring more transparency and allow for a more efficient valuation. That's one option. Transaction of Dow Jones that would disclose the true value would be another option. But all these things, I'm sure, are being considered. But the increasing explicitness of that strategic review gives us confidence that at some point in the not too distant future, there's likely to be some kind of a catalyst or event in order to unlock value. And then, of course, a lot of comments around the shareholding, the interests of the children, the arguments that the children are engaged in at the moment. Thus, it's impossible to say with any degree of accuracy what's going on behind closed doors, but it seems likely that when ultimately 4 children inherit their father's stake in this company, there will probably be arguments. And it also seems likely that none of them, given where they come from, are likely to want to see their stake or trading at a 40-50% discount and are unlikely to be sellers. So they're all incentivized, we would say, to maximize value and to get the share price up and get the discount down. An example of an investment trust on the next slide is Crystalis. Again, it's probably well known, but it's a good example of how AVI's contrarian approach brings opportunities to us to exploit after there's been a period of poor performance, of widening discount and disappointment generally amongst shareholders. Crystalis is well known for having disappointed investors. Management did well out of it, shareholders did a lot less well. We became interested in it about 18 months ago. At the time, NAVs had been written down, discounts had widened, but also we noticed that there was probably an improvement in the environment for exits. Valuations had stopped declining. There was potential upside to come through. And we see that really now coming to the fore when we see indications that Klarna, big holding within Crystalis, is likely to be IPO'd in the next few months, which will probably support the NAV, if not more than support the NAV, bringing cash to the fund. And as you see here, we've mentioned that the company has committed to buying back shares once they have a sufficient amount of capital, £100 million, and buying back shares on 35-45% discounts is obviously very accretive to ongoing shareholders and something we're entirely supportive of. So looking forward, we see a couple of exits coming out of the portfolio, supporting the NAV, bringing in capital, and hopefully allowing the company to focus on narrowing the discount as it moves forward. And then one example out of Japan to illustrate what we're doing and what's going on there. This is a company that's primary activity is owning clothing athleisure brands targeting younger consumers, snowboarding, skateboarding, that kind of stuff. It's a reasonably good quality business. Margins are lower than they should be. Certainly one of the areas that we've been engaging on with the company to improve the margins, broadly speaking, from around 1% to 4%. So a lot of scope to improve profitability. The big attraction alongside that operational enhancement that could come is the balance sheet. The company had, as most of our companies do, substantial amounts of cash, but also a number of different real estate assets that in aggregate were worth more than the market cap of the company. We conducted our own independent valuations of giving us confidence of the substantial undervaluation, and have been engaging for 18 to 24 months with the company on a couple of key areas. Again, these are typical of our involvement in Japan: improving corporate governance, improving capital efficiency, and that's dealing with the cash and redundant real estate, but also the operational improvements. A couple of weeks ago, the company announced the sale of one property asset and a big uplift to their carrying value, of course, but also an uplift to our appraised value. And that capital that's coming in equates to around 34% of the market cap of the company. So very substantial. And the company, in response, has committed to enhanced dividends and using a big chunk of that capital to buy back shares, which is again accretive. So this is what we see time and time again in Japan. Companies beginning now to focus on shareholder returns, working their businesses much harder to improve long-term profitability, but also taking more short-term measures to improve capital efficiency, and thereby demonstrate to shareholders that cash or other assets on the balance sheet do actually mean something. They do belong to shareholders, and they should be considered as something of value rather than something that belongs to the company but to no benefit to the shareholders, which has been the core problem. So increasingly we're seeing responsiveness from management to our suggestions pick up, and also, as I said earlier, companies can do a lot themselves on corporate activity, but if not, there is a growing private equity presence that is exploiting these opportunities. So we'll go back to slide 7 just to end with the portfolio and to open up to any questions if there are any.
Brilliant, Joe. Thank you very much. Just on Japan, there's a question about the yen. Obviously, that's been moving around quite a lot last year. How do you factor that into what you're doing when you're investing in Japan?
So, as a policy, the fund, whether it's AVI Global or AVI Japan, is unhedged. So we have full exposure to the yen, and therefore our yen exposure has been a material headwind over the last few years as we've suffered substantial yen weakness. I think that. Sorry, I'll just make a comment about the yen generally. I see a question's popped up on the screen. And I'll preface my answer by saying that I've been saying for over a year that the yen should be stronger, and it hasn't really happened in a material way. So take everything I say with a pinch of salt. But fundamentally, by traditional metrics of measuring currencies, Japan, the yen is cheap. That doesn't suggest that it's going to reverse that trend anytime soon, but it is cheap. In addition to that, and more importantly perhaps, the economic backdrop in Japan is now much more supportive of a strong yen, and as we've seen from the Bank of Japan, it's much more supportive of a move away from the very extreme monetary policies that we've seen over the last decade, negative interest rates, for example. Importantly, we've seen the end of deflation in Japan. We've seen the emergence of inflation, and importantly, we've seen the emergence of good inflation, which is typically wage increases. Wage increases are key, but there's also bad inflation, which is the result of a weak yen pushing up input prices, raw material prices, and consumers are not happy about going to the petrol pump or the supermarket and facing higher prices. Some of that pain will be alleviated by a boost to the wage packet, but generally speaking, there's a lot of pressure politically to do something about the ever weakening. The key factor here and the key driver, certainly over the last couple of years, has been what's gone on in interest rates in the US primarily. There seems to be an end or moderating in the flow of capital out of Japan into foreign assets. Some of that has come back into yen, which is putting a little bit of a tailwind there, but not in any material big way. But the key, as you heard from the Bank of Japan this morning, is that the economic backdrop is more positive, and the Bank of Japan will remain committed to some normalization in interest rates. But I wouldn't be expecting interest rates anywhere like what we see here or in other Western economies.
You mentioned the US there, and obviously it's a with the big picture thing. You haven't traditionally had an awful lot invested in America anyway, but to what extent do you think the Trump administration is going to have an impact on the portfolio?
Well, we tend not to invest by thinking about these big, broad questions or issues. They're fascinating, and one can sound intelligent or not in answering them. For us, it's very much about the bottom-up individual opportunities. How that fits into what we do is in a number of ways, and we have been increasing our exposure to US opportunities in the last couple of years, and we've been finding a good number of examples. So firstly, to the extent that the US economy continues to grow, that's a good backdrop for our North American companies to continue to grow profits. That's number one. And number two, as I mentioned earlier, there are lots of opportunities when one starts looking in America, because most investors are not looking. They're looking at large tech companies, whether it's the Max 7 or others, they're looking at AI, and it's meant that huge swathes of the opportunity set are trading on very material discounts and very attractive valuations. And the third thing that's very relevant, again, from our perspective, is American attitudes towards shareholder returns, capital allocation, and depressed share prices. In short, it's a massive contrast to what we found in Japan 5 years ago, where management and shareholders didn't care about the share price. And therefore, yes, Japan is moving in the right direction, and that's hugely positive. But in Japan, when we think about opportunities and catalysts, it is quite interesting that we are seeing moves by insiders or management to unlock value and to take advantage of depressed share prices. Where in Japan, we have to teach some kind of basic financial arithmetic about buying back shares. We don't have such issues in the US. That's quite interesting.
There's a few questions about cyber, as you might expect. So actually, let's start with the easy one. So can you just contrast what you did to be trying to do, please?
Okay, so first of all, we like to think that everything we do is constructive and positive, rather than just bullying or aggressive for the sake of it. That's not to say that's what cyber's game is, but just put into context. And when you go back to what I said earlier about buying a pound of assets, where we think that pound of assets is going to grow and compound in value over time, what that means in practice is that we're not just interested in exploiting discounts, bullying management or directors to give us back that discount. We are interested in owning those businesses over time. And that brings with it some patience. And it means that when we're talking to companies, we're not forcing them to liquidate immediately because we want that discount back. It means we want them to focus more on capital allocation, to focus on share price and shareholder returns, but also we're coming at it from the perspective that we're very happy owning that business. And we don't say it's a basket case that you've got to get rid of. So I think that's one key distinction between our approach and perhaps a more activist hedge fund approach, which is oftentimes focused on capturing those discounts. When we do engage with companies, we're looking not to take control of the boards. We're not looking to take control of entire trusts and merge them. We're looking to improve share price, improve the rating, and then move on to other opportunities.
Yeah, exactly. I think that's probably the big difference. There's some specific questions on holdings here. So let's start with D'Ieteren. So that's become a very big position in the last few months. What's the plan with that now?
Okay, so for those of you who are less familiar with it, D'Ieteren is a Belgian holding company. They're now, I think, in their seventh generation of the family involvement. The assets here are largely unlisted, and the key asset here is a company called Belron. Belron is a global business. Listeners will be familiar, or many will be familiar, with the auto glass repair business. I won't sing the jingle, but auto glass repair is a fantastic business. In short, many years ago, repairing windscreens was a very easy business. For a stone in your windscreen, you went to the local dealer, they replaced it. Nowadays, windscreens are extremely complex. There are sensors and cameras all over the place. It's a 20% margin business. So has grown and is very attractive. This is the key asset within D'Ieteren. We increased the holding substantially towards the end of 2024 because there was a transaction amongst the shareholders. There were two groups of cousins who collectively control 50% of D'Ieteren. One is involved in the business and one is more of a passive shareholder. The active cousin bought out the passive shareholder. So it's now effectively controlled in one branch of the family. Now, in order to fund that transaction of several billion euros, the company put some debt on Belron, and Belron paid out a special dividend. We received roughly 75 euros a share as a special dividend at the end of December. And to put that into context, the share price at the time was around 200 euros a share. The share price responded quite badly, quite negatively to the news of that dividend, which we think was unwarranted. But on further digging, I think the cause there was the fact that there were a lot of retail investors, Belgian retail investors there, who were suffering 30% tax, didn't like the deal, were hoping that there'd be more of an IPO-style transaction on Belron rather than this debt capitalization, so they sold the shares. Now, interestingly, AVI Global as a trust doesn't suffer 30% tax, we only suffer 10% tax. And the other interesting factor was that when the share price went ex-dividend in December, it fell nowhere near the full 74 euros that you would have expected it to do. So it showed there was some inefficiency in the market, which we exploited by making this a 10%-ish position at the time. The share price has settled around about 160 euros a share. It remains, we took some money off the table via the dividend. It remains a top three holding for us. And importantly, when we think about the things we look for, it's still a very high quality business. It's got a bit more debt on it, but we think that's very manageable. It's delayed by a couple of years, perhaps an IPO. Again, if the business is growing, we're very happy with that. It trades at a very material discount. We're paying something like 10 times earnings, if not less, for this core operating business, which given its growth, is too cheap. Management demonstrated consistently for many years an alignment of interest with us, and I'm sure that at some point the discount will narrow substantially. I'm sure there'll be some corporate activity. Remember, of course, that some well-known private equity houses are shareholders in Belron. They've been shareholders since some 2018, 2021, and at some point they will want an exit. So there will be a corporate transaction or corporate event.
Cool. We should need to start to more private equity. So you've got Harvest, Locally, and Partners there. So why pick those three in particular?
Well, if you go back 2 years or so ago, the whole sector was interesting to us, was throwing up opportunities. We were almost like a kid in a candy store. And in fact, we had a bit of a scattergun approach, which we don't like really for a long period of time. But at certain points of market transition, it's an approach that we take. And we had a handful, we had up to about a dozen different smallish stakes in a variety of different private equity names and some VC private capital names. The result of that was that we ended up taking some profits in some of the smaller positions, and where we could consolidate that into meaningful stakes in some of the larger names, where we saw perhaps more dislocation in the discount, but perhaps also more angles for us to engage with management. That's typically when you see larger positions for us. In the case of Oakley, it's a very concentrated portfolio relative to the fund-of-fund model, quite transparent, very interesting assets, and we continue to find that very, very interesting. And it has been almost a core position for AVI now for 7 or 8 years. Yes, we've sold some, we've bought some back, depending on where the discount is. Fundamentally, looking at the underlying businesses, where they're carried out, where exits have come historically by the group, we see a lot of potential upside. Other investment partners are more thematic. There are angles that we're engaging with, and the extent of our ownership changes a little bit with discounts.
There's another question here about SoftBank.
So SoftBank Group, just as a reminder, is a Japanese investment company controlled by Masa Son. The largest investment within that group is Arm, which has obviously been doing extremely well, and not a typical AVI investment. And alongside that, there's some small listed stakes in the mobile phone business in Japan, SoftBank Corporation, and also exposure to the Vision Fund, the infamous private vehicle through which SoftBank made lots of mixed investments, shall we say. Some successful, most not successful. The thing that interested us were really twofold. Number one, we took the position 6 to 9 months ago, I think it was, the discount was pushing 60%. Really wide in absolute terms, very wide in its own historical range as well. And on top of that, Elliott had taken a stake. Elliott had some success with SoftBank some years ago where they pushed the company to do a buyback. And that really was an interesting catalyst for us. So when we looked at it, 60% discount, we didn't really see the discount going much wider than that. We saw pressure coming from, but importantly also, the financial position of SoftBank is very different to the last time Elliott were shareholders. Today, the balance sheet was much stronger. There was very little debt. They got capacity to put some debt, and therefore the scope to release capital and buy back shares and affect that narrowing the discount was much greater today. But as I alluded to, we're not necessarily experts in AI and the tech space. We're not making the argument that ARM is cheap and that we want to own ARM. And so what we've structured here is a position that largely isolates the discount and will result in a profit or loss depending upon the moves in the discount rather than a profit or loss being dependent upon moves in the share price and the NAV. In practice, that meant we've shorted ARM, we've shorted some of the other listed assets and have largely isolated the discount. It's fair to say that the company disappointed when they announced a share buyback some months ago that was underwhelming in magnitude. Since then, the discount hasn't really moved. It's pretty much where it was when we first invested, and that's meant that as an investment, it hasn't made a positive return, but equally, it hasn't made a negative return. The scope for returns from here is quite attractive given the magnitude of this discount. So if we went from a 60 to a 40% discount, that unlocks quite a meaningful return, quite a high return, which is particularly interesting given the market neutrality of the position.
Great. I think we could probably keep going all the way down the portfolio if we had time. Unfortunately, it's 12 o'clock, so we'll wrap up there. But thank you very much indeed, Joe, for talking us through the portfolio today. And we will get you back on again in a year or so, and obviously we'll be right at the meantime. So for today, thank you very much, and good luck with everything.
Thanks for having me back.
See you again soon.
Thanks, James.
We just better linger slightly on the disclaimers, very important. And there again, very good. We will be back next week, and we're talking to Doug Brody, who's the manager, or now one of the managers of Edinburgh Worldwide, which is the last vote that is SBER has. So the other ones, as I've mentioned earlier, are much sooner than that, and please do vote now if you can. But we will see you next week. Thank you.